In today's video, we are going to be analyzing the Rapid City, South Dakota rental market for multifamily properties. So you can see this is a smaller market. There's only 132 properties in this market. And where it's located in South Dakota, you can see Wyoming, Montana, North Dakota. Here's Minneapolis, Minnesota, Des Moines, Iowa, Omaha, Nebraska, which we did yesterday, Kansas City, and Denver, Colorado. Here is Salt Lake City, Utah. Kind of give you an idea where this market is located. So if we go in and take a look at our filters that we have created inside of this lovely tool called CoStar, we can see that we are excluding all corporate, all military, all senior, and all vacation. And we are including only market and market affordable, right? And we are looking at all Class A, B, and C assets at one time. And then we will go in and look at the Class A, Class B, and Class C space individually. If we go to our location, we can see that we are in market, metro statistical area, Rapid City, South Dakota. So let's go in and see what the analytics tell us. So here is our supply snapshot for the Rapid City, South Dakota metro statistical area. You can see that there are 132 properties totaling 7,434 units. There are 419 units currently under construction and 335 units absorbed over the last 12 months. So those are additional renters that came to the market in the last 12 months. And the 12 months prior to that, in 2021, there was an increase of 449 renters enter the market. We have had some vacancy increase from 2.5% to 5.4%. That tells me we've definitely had some slowing in our absorption. We will see if we have any negative absorption, doubling our vacancy rate, albeit still a very low vacancy. So if we look at our market rent per unit, we can see that we still have a trend upward year over year in market rent. We will see what it looks like quarter over quarter, and we are not going to be looking at the capital markets for this MSA. If we scroll down and look at our long-term occupancy average over the last 22 years, you can see that we are pretty much right on top of where the market wants to be on a long-term basis. So it looks like it likes 94.4% occupancy, and it is currently at 94.55. So it is pretty easy to plot this market on a market cycle chart where we're going to plop it right dead on that long-term occupancy average. And because we're seeing some uptrend in vacancy and some downtrend in absorption, I'd say that it is probably going to be on the right side of our vertical line or our NOI line in between oversupply and recession. So right on that line. But let's go take a look at the data and see what the data tells us for all three asset classes combined. So here is the rent analytics for all three asset classes, A, B, and C. Once again, we do not look at asking rent. We do not care what owners and managers are asking. We only care what they are collecting. So we only look at effective rent. We can see that in first quarter of 2022, it was at $11.41 a month, went up to $11.67, down to $11.42, so back where it was, up to $11.58. So we got a little bit of a roller coaster action happening here. Pretty interesting story. So let's look and see what deliveries and absorption tell us. So we can see there were some deliveries, not a whole lot. Of course, we don't really have a whole lot under construction either. This is a pretty small market. There were 15 delivered in the first quarter of 2022 and 61 absorbed. So 4 times more absorbed than delivered. Then none delivered in the second quarter and 26 absorbed. Then 126 delivered and 91 absorbed. So not too terribly bad there. And then about 50% absorption for the fourth quarter. So we are seeing a slowing in absorption as it goes through the year, but it's interesting that we have that roller coaster effect happening in our rents. So if we look at where we started in occupancy, we were at 97.9, went up to 98.3, down to 97.8, down to 95.9. Conventional wisdom would have said we should have downtrended in rents this whole time, but we are right at about that long-term occupancy average. So we may start to see some downward pressures in the rents moving forward. So that's what all three asset classes show us, right at about that long-term occupancy average. The numbers show us that. Let's see what the Class A's are saying to us. So here is our Class A rental analytic data. There are only 9 properties totaling 1,368 units in the marketplace. We're looking at effective rent. Rents started the 2022 first quarter at $1,290, went up to $1,375, down to $1,253, up to $1,322. So again, that roller coaster effect. Let's see if we have deliveries and absorption telling the same story. So no deliveries first 3 quarters and only 139 delivered in the fourth quarter, and we've got some negative absorption. So our waffling effect is definitely showing here, and why it is showing. So it looks like that the Class A market is slowing down. The good news is there's not a whole lot left to deliver. As a matter of fact, according to CoStar, there are no more units to deliver in the Class A market. So this market is now stabilizing, and it is stabilizing right around that long-term occupancy average. So we'll see if the renters like where it is here or if it's going to continue a downtrend. Only time will tell, but it's right on that teetering point of sitting between oversupply and recession. We'll see what it does. There are markets that will skip that recession phase and just go down really fast and kind of back up the other side, because on a long-term period, they have that long-term average of a really high occupancy, which we can see that Rapid City does. We also know that this market is affected by oil. So there's a lot of natural gas. There's a big natural gas shell in this market, and it grew pretty considerably back when that boom was happening, and we can see that happening here back in 2013, 2014, when all those jobs came to this market and really grew this market. So let's go and see what the Class B space is telling us. Not enough Class A here to make any kind of decision whether it's holding it up or pulling it down one way or the other. Here is our Class B rent analytic data. There are 49 properties totaling 3,516 units. We are looking at effective rent, and starting in the first quarter of 2022, it was at $1,167, up to $1,181, stabilized from second quarter to third quarter, stayed at $1,181, and then up to $1,193. So no downtrend, a stabilized between 2 quarters, and then back to that uptrend. So let's see what our deliveries and our absorption tells us. So we did have some deliveries, none in the second quarter, very small amount in the third. Looks like you absorbed almost all of those in the first quarter. In the third quarter, 126, almost absorbed all of those. And then a bit of a slowdown in the fourth quarter, delivered 149, only absorbed 42. So again, keeping up with the deliveries for the most part until that fourth quarter. And you can see we were at 98.4 in the first quarter, went up to 98.6 because we had more absorption than we had deliveries. Then slightly down because we did not keep up with that trend. And then quite a bit further down because we only absorbed about 30% of what we should have, maybe even only about 25% of what we should have. And so that's why we see that 2% downturn, or about 2.1%, 3.1% downturn. So that makes perfect sense. And when we look at the rents, it doesn't explain why the rents are going up. But again, we're still slightly, ever so slightly at or above that long-term occupancy average. So I'm not too concerned there. This is a very high occupancy market. We'll see how it does moving forward. There are still 469 units under construction, And even though that's a very small amount, this is a very small market, so that will affect how the deliveries and absorption go moving forward. So we'll see what first quarter 23 tells us once we get into the second quarter. Way too early to make any decisions right now. So let's go look at the Class C space. Here's our Class C rent analytic data. There are 66 properties totaling 2,182 units. We started the year in 2022 with effective rent of $988, went up to $998, slightly down to $993, slightly down to $982. So it looks like this upper Midwest, the Class Cs are the weak apartment asset class in the upper Midwest. In the Sun Belt, they're the strong rental class where we see growth in effective rent quarter over quarter in most of the markets in the Sun Belt. But in the upper Midwest, it looks like just about every market we've looked at, we're seeing this uptrend in Class Cs. At least that's what we've seen this week between Indianapolis, Grand Rapids, Omaha, and now Rapid City. So let's look at absorption and see what absorption says, because we should not have deliveries, under which we do not have any deliveries. Ignore the 92 under construction. And like we've seen with the other ones, you've got some absorption early on and some negative absorption later. But if we look, we're still well above the long-term occupancy average at 96.5. So if I owned in this market, I'd say at 3.5% vacancy, I got some room to grow some rents. That's just too small. So I'm going to keep increasing my rents until this number comes down. So this does not surprise me. Pretty decent market. I mean, everything we've looked at this week so far in the upper Midwest has held pretty strong. So for the market cycle position for the Rapid City, South Dakota metro statistical area, I would plot it on the long-term occupancy average because we are right at that point overall. And moving forward, we may see it trend down into recession. Honestly, I don't think it's going to stay there very long. I think it will come right back, barring some collapse in the oil market or maybe some onerous legislation by the federal government that could cause this market to go negative. But barring something like that, this market shows some pretty good strength through hard times. So I think it may sustain fairly well. I like this Rapid City, South Dakota market. And I would encourage any other investors to like it as well if you can stomach a small market like this. So that'll do it for Rapid City, South Dakota. We end the week tomorrow taking a look at Cincinnati, Ohio. I will see you tomorrow.